Thanks for joining us at the Property Frontline. Today I'm here with Ken from Avvora Finance, and today we'll be discussing issues relating to obtaining finance. So, hi Ken.
Hi Debra.
So tell us a little bit about what you do.
As a finance broker, I guess we help applicants or borrowers who are looking to get a loan from a lender and just kind of work through what their scenario is and matching them to a lender who will approve the loan and give them the amount that they're after. Because usually it's just there's a target amount that they're wanting, whether it's for a purchase, cash out, refinancing. There's usually a driver or purpose behind that, and then it's kind of identifying what those exact needs are, and defining it clearly, and then kind of going out to see which lenders will facilitate that and lend the money for those reasons. Because some scenarios will match with some lenders, some won't match with others. Yeah,
and I guess we'll talk about that a little bit later, because there is so many different aspects that people need to consider.
Yep.
Okay, so you're a broker. So why is it better for people to work with a broker rather than going straight to one bank?
The first one that comes to mind is probably the ability to work in contingent plans. For example, not all lenders, if you're looking to purchase a property, don't offer pre-approval. So if that's your preferred lender, do you want to kind of go in and risk it and just, fingers crossed, sign a contract to sell, and if that lender doesn't approve the loan, what are you going to do? Whereas, we may be able to look at a contingent lender who maybe does do a pre-approval, and if the first lender doesn't proceed with the application, you've already got another lender to fall back on. There's no guarantees that you get the loan with the lender who gives the pre-approval, but it gives you a bit more confidence in knowing that there is a plan B should things not quite work out. Could be a range of things: income, the property they're not too interested in, LVR levels, the purpose. There's a whole bunch of reasons why they may not go ahead with it. Yeah,
and from my perspective, if you're building a portfolio, you don't want to be with just one bank.
Yeah. I kind of find that a lot of the clients that I kind of interact with, they get a lot out of the scenario modelling and things like that. So, sometimes you're not 100% sure which way you want to go. It just depends on the way the numbers stack, which then, that's something that we can facilitate. You can do that with one lender or one bank, but your options are, relatively limited. Like some lenders, do the guarantors and things like that, or have credit policies which allow you to debt apportioning, where they kind of split joint debt up. Some don't. So being able to work out who would be able to facilitate that, what your options are, it's sometimes, which we'll get to. I was going to talk about the pricing kind of thing, but sometimes, there are other things to kind of look at when applying for a home loan.
Yeah, and I guess that leads into our next question. So why should people think about more than just the interest rate when they're selecting their loans?
Yeah, so like here, when we do our research and we meet a new client, interest rate's always inbuilt into the process, I guess. So naturally, the assumption is that everyone's looking to pay as little interest as possible. But interest is one component. You've got your application fee, lender's mortgage insurance. Sometimes you can avoid it, sometimes you can go for it. Other times it could be the way that the loan's structured, and if they've spoken to the accountant and they want it set up in a particular way for tax purposes, we can cater to that and identify lenders who will cater for that. So and those savings could offset the interest, so you might be paying a little bit more, a couple of bips more on one product, but it allows you to save from a tax perspective, on the advice of an accountant. So there's a lot of different there's a lot of different items that we would kind of take into consideration. Then you've got also added like things like, do you go fixed or variable? On top of that, there's promotions as well. So it really does depend on what the circumstances are. But for us, I guess, so interest is always the front of mind, but interest cost is front of mind. But, for us, it's probably looking at the scenario and going for the loan approval, because there's no point in looking at a lender who has, let's go with like a 1% interest rate, let's just say ridiculously low, but you don't even qualify for that product. There's no point in really, entertaining that idea and looking down that path, because you just, they could have a really hard criteria, like they'll only lend. No one has it. I'm just, it's an example, but 50% LVR, let's just say.
Yeah.
And generally
What's
speaking,
one?
everyone kind of goes around the 80, 70, 90 mark. And if you do sit those situations, then yeah, it makes a lot of sense. But more often than not, there are other things. And the other thing that I'd probably mention is the timeframes. How quickly. There's another one as well, which is borrowing capacity. So time frame, sometimes it's a situation, it's a pinch, we need to move fast.
Yeah.
And then other times it's borrowing capacity, who's going to lend us more money to get this done. So approval, speed, borrowing capacity, there's a whole range of other things as well, to kind of help facilitate, the decision on which way to go.
Yeah. And even once people have all of their loans set, like we were just talking about before, there's a whole range of issues around refinancing at the moment, isn't there?
Yeah, refinancing is an interesting one, because I think the assumption is once you've got the loan and the loan amount that you previously qualified for, there shouldn't be any issues moving around. But yeah, at the moment, I mean, when borrowing capacity is reduced and the lenders kind of tighten, you may not qualify for the same loan amount, which means you're kind of stuck with the lender. It's the same as well with lender's mortgage insurance. If you're above the threshold, usually 80%, there may be one or two who's 85%, you might need to repay or pay the lender's mortgage insurance with the new lender and not get a refund for your previous lender. So then, feasibility in terms of whether it's still better just to stay there, technically on a higher rate, but the cost to refinance is substantially higher, so that could be a barrier for you to leave it alone. Usually staying with your lender, there's from a cost perspective, there isn't the discharge fee, the application fee. Lender's mortgage insurance fee can be a substantial one, which would keep you put.
And of course, any time you do anything in relation to your loans, you have to always think, well, is this going to impact my credit score? But the work that you do, you would keep, you would make sure that the information didn't imprint on the credit scores.
So we can because we do have relationships with the lenders, and we can actually workshop with them to see who would likely approve. We can't guarantee that the loan will be approved, but we can quickly, probably the better way to put it is, we kind of identify lenders who will just, highly unlikely approve the loan. So it's just not within their policy, and they'll just say, no, this definitely doesn't fit for us. And we can workshop with them and ask them. Usually the process is to kind of do the full financial position, income, assets, liabilities, and expenses, and then from there what the needs are, and then we kind of work out what are the key items that you're looking for from that, and then identify the challenges, and then work out which lenders just can't resolve that, can't mitigate that risk or whatever, it just doesn't fit with them. We exclude them, and then we move on. So you can actually workshop some of the things. This is even before submitting an application. So you will have a range of lenders then to choose from, which have not shown any indication that they won't approve the loan, or will likely approve the loan, consider the loan, should I say. And I guess that's the other thing, with the process, not just about the interest rate. Like working with a broker as opposed to going to one lender, we know that there's different types of. Some lenders will say yes, some lenders will say no, some sit on the fence, sometimes they do the maybe, I don't know. But we can have that conversation with them, and this is prior to actually submitting an application, which means it doesn't go on your credit file.
Which is very, very important.
Keeping a clean credit file.
Exactly.
On a random off note, there was a client who, it's important to check your credit files, because one of my clients actually had an application declined because their credit files were mixed in with another person's credit file. So literally the date of birth was incorrect, the name was wrong, but the driver's license was right. Some of their debts had come across and merged into their credit file. Wow. So, and it was an interesting situation, because I actually had it approved with the same lender, and then when we went to renew it, they picked it up. So I don't know what the go is there, but keep making sure that you kind of have a look. You should be able to access your credit file once a year for free. I've
got a subscription, and so I get monthly updates about mine.
Yeah.
Because we shopped around for one of our loans and didn't realise this was in the early days.
Yep.
And it was pinging out
making a whole bunch of some lenders do automatically decline if there's a certain number of there's a threshold on the number of inquiries within a certain period of time. You hit that limit, they auto decline it. Others will still assess it, so that's just something to keep in mind.
There's so much more to it than people realise. Okay, so in our current market, as at winter of 2020, is it easy to get a loan now as compared to when?
Previously, I'd probably say there's a lot more scrutiny on income at the moment. So anyone with variable income who has a substantial amount of income coming from investment properties, probably variable income such as or contract work, self-employed, you're probably going to find harder in the sense that there's probably a little bit more requirements for supporting documents and verification and things like that. Some lenders have gone a little bit more conservative. They've cut down the amount of income they would include from loadings, casual,
and rents.
Yeah, and rents as well. They're just being cautious in that regard. So, yeah, it's a little bit harder, but it kind of, like these things change on a dime.
Oh, I know, and it can't be as difficult as it was. Like this time last year, so before the federal election, so April 2019, when things were just like really, really tight.
Yeah, it was the pinnacle. Like prior to the regulators coming out and saying, we want to kind of get the lenders to loosen up the floor assessments rates. Before they were sitting at like 7-point-something% minimum. Now they're like around about the 5%. So if you're looking at a loan, they sometimes have add a buffer to the interest rate, so you might be applying for a 3% loan, but they'll use 5% or 5.25% to work out what the repayments are, so that if there's any increases, you can make the payments. I think, but it was previously at like 7.25 was a bare minimum, 7.5 something like that. So it does ebb and flow. Prior to the pandemic, it was actually easing, and now it's contracting. But who knows what will happen in the next couple of months? It could just stay the same. Or it could go up, loosen or tighten. Not sure.
So my bet would be that the banks would be getting the word to free up the cash, because all the taps of the economy need to be turned on so that everybody can so we can get back to
and get the economy going again.
Yeah,
definitely.
Exactly.
At the moment, I mean, they're looking at refinances at the moment. That's probably the biggest thing. That's been the biggest push. There's been a lot of offers and promotions and things like that to kind of, encourage people to kind of refinance. I don't know how that goes with actually putting money into the economy because of refinance.
No.
Maybe if you save and then it's not probably a direct
more,
thing. It could be, unless there's a cash out component or something like that. But that's where the market's at the moment.
Okay. Alrighty. So in relation to how much deposit buyers need at the moment, so when things were really, really tight about 12 months ago, banks were really expecting the 20%, as opposed to, say 5 years ago when you could pretty much do it for like zero deposit.
105% loans prior as well. But
good old days. So where are we sitting at the moment?
Look, you can purchase a property if you had 5% deposit. But the caveat there is that a lot of things need to line up. So the biggest transaction cost usually is going to be lender's mortgage insurance and the stamp duty. So to address the stamp duty, if you qualify for the state's grant, so that depends on your property prices as well. So if you qualify for that, you don't need to pay that. Perfect. Then the first home loan deposit scheme. So if you qualify for that and secure a spot for that, at the moment there are no spot. New spots are coming out in
July.
In July.
Another 10,000.
Another 10,000. So if you qualify for that, then that'll address the lender's mortgage insurance. Because lender's mortgage insurance, on a $650,000 property in New South Wales, it's pretty much on par with stamp duty. Numbers are like close to like
25.
20, 23, 25,000, something like that.
Wow,
you know.
they really get you, don't they?
It's and then you combine that with stamp duty, that's like already 50,000. And if you're 650, it's like you know, it's definitely that, and that's just to pay for transaction costs. This is not putting any money down for the property, right?
That's no deposit.
Exactly. So you can't borrow the full amount. So your transaction costs. I find that most purchasers tend to forget about the transaction costs.
Yeah.
Especially the stamp duty and the lender's mortgage insurance. Those are critical items.
Yeah.
Yeah. So you could technically.
It's possible.
You could.
Yeah.
You know, I mean, there may be other options as well. Like if you introduce things like guarantors and things like that. Generally, you do need to kind of show that you have had 5% genuine savings. Usually, that's a rule that lenders have. They want to see 3 months history of savings. Of course, there are other ways to kind of address that item, but generally speaking, 5% would be the bare minimum. But then, one thing I'd probably mention is that everything's pretty tight. So the number of lenders kind of decrease, so your options are quite narrow. Yeah. Which, who knows what that does with interest rates. Sometimes it's perfect, and the most competitive lender on our panel, let's just say, offers it, so you can go with them. So your options are limited, and then even contingent plans. So looking at the risk aspect in case the primary lender doesn't approve the loan. What are your contingent plans? If you had more lenders available to you, and your loan wasn't as unique, I guess, you've got more options to go around. And I think that kind of ties into the why you wouldn't go to a broker as opposed to one bank, because we can play around with, we'll look around and play with the credit policies that different lenders have and kind of tailor it to to the situation.
Your specific needs. Okay, alrighty. Well, thank you so much for providing us with that insight. If you've got any questions, please send them in to us at the Property Frontline. Otherwise, Ken can be contacted through avvora.com.au and his social pages.
Yep. Perfect.